On Monday, S&P roiled financial markets when it revised its outlook on the United States to negative. Although the U.S. government retains its AAA debt rating, a warning was delivered that expanding deficits and political battling risk the nation losing its top-tier rating for treasuries. Addressing the move by the rating agency and what it means in the long term is BlackRock CEO Larry Fink. The co-founder and the CEO of the world's largest asset management fund, BlackRock, Larry Fink manages over $3.5 trillion, which is nearly double India's GDP. Bloomberg is in conversation with the man himself.
The market is anticipating the end of QE2, and so the marketplace is all set up for a rising yield market. And yesterday's warning shot from S&P is another good indication that the market is technically short. And so we can't look at the implications in one day. I think that's pretty misguided, and hopefully we don't set policy for one-day market moves, but we have to look at over a trend. This clearly is an indication of a bad trend. It's something that should not be a surprise. You know, when we have deficits going from $400 billion to $1 and $1.4 trillion, it's a negative trend, and that trend is why I think S&P has put us on credit watch. They're basically saying we cannot live with these deficits of this large scale.
A lot of people have been expecting one of the credit rating agencies to come out with an announcement like this for some time. Does it feel to you, though, like they're perhaps getting a little more aggressive? We've talked for so many years about credit rating agencies being a lagging indicator. It happened in Europe. S&P, or neither S&P nor Moody's, woke us up to the real threat of sovereign contagion in Europe. Is this a little more of a preemptive strike?
Well, I think there's been so much criticism directed at the rating agencies for, as you said, missing the subprime and other problems associated with structured finance. The rating agencies have been actually a good indicator in corporate credits. And I think they've ramped up their position as to how they actually act and what is considered responsible. And I think what they did is a preemptive indication. It was not a downgrade, it was a warning. And we have to take that as a warning, not as a downgrade. We've been, there have been other times when we had a negative watch. I think the last time was when we had all the fighting in Washington related to the debt ceiling in the mid-90s. And so this is not the first time it happened. It's basically asking Washington to be responsible.
What does Washington need to do to assure Treasury investors that this deficit situation we're talking about isn't going to end in tears?
Well, I believe Washington has to be extraordinary in dealing with this. This has to be...
That doesn't happen very often, does it?
I'm saying it has to be extraordinary. My view is Washington, in the next 3-4 weeks, needs to come to terms with the scope of the deficit. My recommendation to Washington would be for Congress to come together and announce that they are going to cut the deficit by a minimum of $4 trillion. And they do this by May. And not the content of how they're going to do it, but come up with an agreement.
A commitment, effectively.
Commitment that we're going to cut the deficit by $4 trillion.
Over what period of time?
Over 10 years.
Okay.
So I think this is where, and it could be larger, but I think let's set that as a floor. And from what I've been reading is both Democrats and Republicans have said $4 trillion. Republicans may be saying more, but let's start there. I'm happy with $4 trillion. I would like to see over time more, but let's start with $4 trillion. Congress accepts that. And then I would like to see Congress working with the president from May, if they come up with that commitment of a $4 trillion minimum reduction, between May and October, to come up with the details of what will be cut. And through that, we will then understand, before the real electioneering pattern begins, November, when we have a one-year period.
So you think it's critical for this to be done, not just, so the commitment to be announced before we get to the debt ceiling hard stop?
I think that should be both. The debt ceiling has to be raised. To me, that's a given. That's just an irresponsibility if we don't raise the debt ceiling. So that's just going to be Washington drama. But the debt ceiling has to be raised, but they have to have simultaneously this commitment by both parties to reduce the deficit by a minimum of $4 trillion. And then between May and October, Washington can come up with the details of where the cuts rates will be. And that's obviously the hard part. And it's important that we as voters understand how are we going to be cutting this deficit? And it's only fair to voters to understand how each party portrays this as we get into elections. We cannot afford to 2013. So I assume we're not going to do this in 2012. So my view is we need to do it this year before the campaigning begins. We need to do it seriously. We need to show the rating agencies, our foreign investors, ourselves that we are resolved in really reducing the deficit.
So you say $4 trillion, a commitment, right, a floor of $4 trillion over 10 years, that would reassure you, and you being a relatively important person in this debate, running one of the largest private investors in Treasury securities in the world.
That would be a great commitment, and I think it would also reduce the threat of much higher rates, on top of the cessation of quantitative easing too. Okay, well, that brings up an important point. Would you expect to see, failing such a commitment, a meaningful increase in Treasury rates? Well, there's a raging debate going on that right now. One would think rates would go up. The Federal Reserve bought $1.3 trillion of securities, which represents about, what is that? Over 10% or approximately 10% of the overall debt outstanding. And if they're not going to buy it, we need to replace that, especially with higher deficits. On the other side, though, banks, because their assets are so short now, we anticipate over the next year banks are going to have their C&I loans and their structured bonds rolling off to the tune of $2 trillion. So there's certainly ample private need for more debt issuance, and they may be, banks may be a big buyer of treasuries.
So it's no guarantee. In fact, for the structural reasons you were just outlining, there's no guarantee that the bias is towards meaningfully higher treasury yields right now.
One would think we're going to have meaningful higher treasury yields, but it may not happen. The technicals are very strong. But the issue for me, what really is really key, we're spending over $440 billion this year on interest payments in our debt. Before 2008, our federal deficits were never $440 billion. And if interest rates go up 1%, the deficit, the debt payments go up to $140 billion each period. So we could have interest payments of $540 billion, $550 billion next year.
But last time you were here in early March, you said you were growing slightly less constructive, as you put it, on equities, a little less confidence in the ability of equities to continue ramping up than you were in the second half of last year. How do you feel right now?
I'm basically the same place. I think equity markets, especially U.S. equities, will continue to rally. I think it's a safe haven in the world. We still have very high dividends in terms of our stock prices. Our earnings are increasing as evidence of J&J. So I believe we have strong fundamentals in U.S. equities, and I do believe U.S. equities are the most underinvested asset class. But there's still,
after all the money's been coming in off the sidelines,
not that much. We still have mostly people short U.S. equities versus other areas. People were
underallocated, in other words.
Yes.
Before we go, we have to touch on one subject we didn't get to, which is inflation. So critical to the Treasury market that, as we've seen recently, so critical to what's going on in emerging markets in general and those economies.
Well, inflation in emerging economies, where food represents a higher component of their economy, inflation is raging because of food and food prices. In the United States, food only represents 15% of our index.
So is it a threat or not for us, for the bond market?
Inflation?
Yeah.
I don't think inflation will be a threat for the bond market in the next year or two, but once housing stabilizes, and housing represents 45% of our inflation index at this moment, once housing stabilizes and starts creeping up between food and housing, I think we can have more of an inflation.
Housing stabilizing seems far away.
2 years.
2 years.
2 years.
Right. And gold at a record, I'm guessing that's in part to inflationary concerns.
I think that's just more global instability, uncertainty. I'm not sure if it's an inflation bet. It's a safe haven.
All right.
All right. The word on inflation from Larry Fink.
And angry birds, actually. Less of a word
angry
on that.
birds.
He didn't
Larry,
really answer.
it's been great to have you here on the Inside Track. Larry Fink, the chairman and CEO of BlackRock.